Listen, let's dive in because I know everybody's really excited to hear from you on your big ideas.
Okay, terrific. And we passed quickly by the chart that showed the 15 big ideas. 6 of them are new, and the others are continuations. These are big ideas. They're multi-year in length. And in fact, the 5 innovation platforms around which we focus our research involve 14 technologies. And these platforms are launching pads for more innovation. So that's why we have 6 more big ideas this week. So here is the first one. Deep learning could create more economic value than the internet did. So I want to illustrate a few things here. The reason deep learning has happened is because we've taken the human programmer out of the equation. We've got data training machines, and we've got big data, iterative algorithms, supercomputing power, and the power has reached a point where now the machines are training themselves. Human beings cannot possibly conceive of all the possible permutations out there when they're saying, when they're trying to program, let's say, an autonomous vehicle. It's not possible. But machines can train themselves, and deep learning is the way to do that. What's interesting about deep learning is training costs, like for autonomous vehicles or autonomous taxi networks, or for Alexa, or for TikTok. Those training costs are dropping 37% per year. And the models, the artificial intelligence models built around deep learning, are growing tenfold per year. So the computing power that we're going to need in the years ahead is enormous. So we think that the market will scale to $30 trillion in opportunity in the AI space from $2 trillion now. That works out to a 17% CAGR, or compound annual rate of return. You look at the green part of the bars, that's the internet. And you can see it will increase from 13 trillion to 20 trillion, but AI is going to be taking over in terms of growth trajectories. In fact, by the time 2037, the internet will be very mature, and the growth rate from 13 trillion to 20 trillion over that 17-year period actually equates to only 3%. So the real growth is in deep learning, and it is the next big wave. Let me get to the next chart. Server processors will transform the next decade. Okay, Intel has dominated, Intel's x86 has dominated the data center. The servers in data centers, 92% of them have an Intel x86 processor. That is going to change dramatically. By the year 2030, we believe Intel's share of the data center will drop to 27%, 92% to 27%. Intel has really lost its way. And we do believe that ARM and RISC-V are going to displace Intel. They together will grow at a 45% annualized rate over the next 10 years. Now, as you know, perhaps, NVIDIA is in the process of trying to acquire ARM from SoftBank. It may or may not go through. It really depends on China, believe it or not. And I thought with the new administration at the helm here in the United States, that the odds of that deal were going up. But we're hearing some rumblings today, just in this last week, more saber rattling from our end. So we shall see. We shall see. Virtual worlds, this has been a long time evolving. You remember the Google glasses. premature. The technology was not ready and the costs were not low enough. And believe it or not, that is still the case. But we are beginning to see breakthroughs now that could really impact the gaming market first. So you can see here the gaming market, and this is the gaming market as you and I know it, which includes both the premium $60 games plus in-game purchases. You can see that we expect a 16% compound annual rate of growth during the next 5 years. Now you'll see that's coming much more from in-game purchases. So that world continues to transform. What's been really interesting about following the gaming sector over the last 25 years is that every time a new technology has evolved, the gaming sector has seen incremental growth. That is unlike video and music. With each new technology, they got hit. Gaming is the only area we've seen that has been able to migrate from one technology to another, and the space gets bigger. We believe this is about to happen once again with artificial reality. Artificial reality and virtual reality. So we are looking at a 59% compound annual rate of growth. We do think the technology is almost there. We know that Facebook with Oculus has been seeing some good success. It's been sold out of its latest model. We believe COVID-19 helped to accelerate that, as it accelerated so much in innovation. And so pay attention to this space. It could be very exciting. Digital wallets. These are the new bank branches in our pockets or in our handbags. And we believe they're going to scale. They're in the process of scaling now. Here in the United States, it's Cash App and Venmo primarily. Of course, we've seen WeChat Pay, and Alipay scale in China. So we were a little more developed and had good financial rails, which China did not. So they led the charge into this space. Again, the coronavirus has turbocharged it. The reason this is happening is not just because we're dealing with contactless payments. So, we don't have to worry about the virus with digital wallets, whereas we do with credit cards and debit cards. I think they actually are more virulent in terms of spreading the virus than cash itself. So digital wallets have gotten a booster here, and their cost of customer acquisition is a fraction of that of traditional banks. $20 versus anywhere from $150 to $1,500. And the reason banks were willing to pay so much is their customers were so loyal. Well, we think that's about to change and that banks are in trouble. And we think that the valuation of these digital wallets is going to scale enormously during the next 5 to 10 years. So today, you can see here on this chart, Venmo and Cash App are valued in the marketplace at roughly between $250 and $700 per user. And we see that we believe if they capture the share of banking business, brokerage business, insurance, we see that they could scale to nearly $20,000 per customer. Now, what we've included in this big ideas that we did not last year was 10,000 of that, roughly, will come from e-commerce. If you study WeChat Pay, you'll see that half of the time spent on WeChat Pay is in payments and then half in e-commerce. So again, another big opportunity that we really hadn't taken into enough account last year when we did big ideas. Bitcoin, more in the fintech realm. We are seeing corporations, we didn't expect this. We expected institutional interest, but we didn't expect corporations to substitute Bitcoin for cash. MicroStrategy was the first. All of its cash is now in Bitcoin. And in fact, it did an offering so that it could buy more Bitcoin. It is a technology company. I'm a little suspicious. I don't know what the SEC is going to do with this, because this is not its base business. This is its cash. Square has put 5% of its assets into Bitcoin. And we're seeing more mature companies like PayPal enabling the buying and selling of Bitcoin on its platform, as Cash App does as well. Well, if companies in the S&P 500 were to put 1% of their cash into Bitcoin, that would increase the price of Bitcoin by $40,000. Today, it's close to $30,000. So that's more than a double right there. If we saw 10%, of course, that would add 400,000. And I just told you, MicroStrategy has put all of its cash in. Perhaps emerging markets will be faster in terms of adoption. But we have been very surprised at how quickly this has happened in the United States. Institutions are going to have a significant impact on Bitcoin's price. We're seeing all kinds of evidence today. I just gave you some about corporate cash, but we have the OCC before Brian Brooks departed. In last July, they allowed custody banks to federally chartered banks to custody Bitcoin. And just within the last month, they have allowed banks to actually become nodes on any public blockchain so that they can enable much less expensive and efficient settlement. So that is again a little faster than we would have expected. We've seen Fidelity. The infrastructure has certainly been moving into place for a while. Fidelity, the Intercontinental ICE, the Intercontinental Exchange, the CME, and Cambridge. The consultant wrote a paper it was a little more than a year ago, basically telling institutions, hey, this could be a new asset class. And it has a very low correlation. In fact, it has the lowest correlation if you compare Bitcoin with all the other major asset classes out there. It has the lowest correlations of any other combination. So we believe that here you can see that if our analysis on how institutions will look at allocating to this space is correct, and this is using a Monte Carlo simulation, institutional involvement could increase the price of Bitcoin. Again, it's 30,000 now, by 200,000 if they want to minimize volatility, to 500,000 if they want to maximize their Sharpe ratios. So quite a bit of work. Yassine El-Mandra, our analyst, has 2 white papers. And I should mention, all of our analysts have white papers, more extensive white papers on our site, and most of these topics.
Cathie, can I ask you a quick question? So, because we've done a lot of analysis on Bitcoin among financial advisors and their clients. And the clients are talking about it, advisors are talking about it. Do you think, based on your analysis of Bitcoin, that eventually it makes it to clients of financial advisors? Is that going to be in the form of a Bitcoin ETF? Is it going to be in the form of something like Grayscale? Or will it be in the form of investing in an active fund or an active ETF like ARK, or we know Guggenheim just got a mandate that they can allocate as well? Where do you think that the allocation for our clients will come from in the form of Bitcoin?
Well, we still think, I know that the ETF question is still out there. We still think the SEC is reticent, although I will say the new SEC chairman, Gensler, he spent time at MIT between his stints in the government and is very pro-Bitcoin, interestingly. And so he understands it more. I think the showstopper short term is Bitcoin. If you look at its market cap, it's $600 billion. That's like one large cap stock. So I think that what we need is for more equivalent of market cap or network value in Bitcoin. And then the SEC will be much more friendly to it. The other interesting thing that's happened at the SEC is the head of the SEC's crypto research division has been promoted to report directly to the chairman. So I think we're going to see a lot. First of all, there's more understanding. I think once, I'm not going to pick a number, but I believe it'll have to get well past $1 trillion because an ETF, the flood has to be satisfied. The flood of demand has to be satisfied. So it's going to have to get well over $1 trillion, $2 trillion, I think, before the SEC will feel comfortable about an ETF. But in terms of other funds, they may be more open. Funds that can close, that don't have to buy, mutual funds don't have to buy. They can allocate elsewhere if they get flows. So it may happen. It may be that mutual funds might get first dibs there. In the meantime, GBTC, it's not an ETF. It is it's a grantor. The underlying is a grantor trust. That seems to be the way that 40 Act funds have. That's how we have gained exposure to Bitcoin since 2015. But I do think there are going to be a lot more alternatives that are less expensive. And I know of some private funds that are less expensive than GBTC. They're more like VC funds now that will ultimately turn into hedge funds, maybe take carry down the line. So there are all kinds of wrappers evolving, I think, for crypto.
Great. Well, thank you. I know a lot of people were interested, but they're also interested in EV. So let's continue.
Okay. Well, we just got the final stats for 2020. EV sales last year were 2.2 million. They grew more than 20%. It was around 25-27% last year. And the traditional market for autos, so the internal combustion engine, those were down. And now we've seen this 2 years in a row. And I think we're going to continue to see this. We're going to continue to see gas-powered cars, the sales fall, and electric vehicle sales scale at an 82% annualized rate over the next 5 years. The reason is the costs are going to continue to fall so that by 2025, the cost of a like-for-like electric vehicle comparable to a Toyota Camry will be $18,000, while a Toyota Camry will be about $26,000. And the cost of electric vehicles will continue to fall from there, while gas-powered vehicles, very mature, will be stagnant, if not have to move up. So we think that traditional automakers are going to be in a world of hurt. They have to convert to electric, and then they have to convert to autonomous. And I will get to autonomous in a moment after this jog towards automation generally. We believe that, well, first of all, to set this up, it took the manufacturing sector 25 years to go from 20 robots per 10,000 employees to 200. We believe over the next 5 years, it will take the entire US economy just that 5 years compared to 25 years to go from 20 robots per 10,000 employees to 200. And with that will come, we believe, increased productivity, increasing wages, increased margins, and increased capital spending. That has been the history of automation. And oh, by the way, the history of automation is also the number of employees, the jobs being created out there will also increase. Automation very often takes, basically displaces unpaid labor and brings in paid labor. That's what we think is going to happen with food preparation and delivery. A lot of people, unpaid, make their own food. We believe that's going to transform during the next 5 years fairly dramatically as well. Here's what we believe is going to happen because of autonomous ride hailing. Well, let me set this up first. Right now, ride hailing, not autonomous, is a $150 billion industry. And ride hailing is or costs the consumer on average, almost $2 per mile. At scale, autonomous will cost only 25 cents per mile. Therefore, we think it's going to scale to, in terms of revenues, from that 150 billion in terms of human-driven ride-hailing platforms to $6 to $7 trillion by 2030, with $1 trillion in operating income, roughly, which we believe by the year 2025, the market will start to discount. It will understand that autonomous is here, and it will discount such that we think autonomous taxi platforms and all of the ecosystem around them will be valued at roughly $4 trillion. So that comes out of the platform provider. You can see 1.2 trillion. That's in operating earnings. The auto manufacturers, these are for the autonomous electric auto manufacturers, that will be about 250 billion, and fleet owners will be 70 billion. Now, here is some of our work on drones. So Tasha Keeney and Sam Corris have done our work on drones. And you can see here the outcome of the collapse in costs, delivery costs that will be associated with drone technology. And again, this is the hardware costs coming down dramatically enough, and the artificial intelligence becoming sophisticated enough, not only to do autonomous vehicles on the ground, but in the air. And you can see the scaling of the businesses that we see. Parcel drones, $114 billion business in 2030, $30 billion in 2025, from nothing now. The hardware sales, $25 billion in 2030, and mapping revenue. So the real opportunity will be in the delivery revenue side. Now on to space. Orbital Aerospace is a big idea. And we see two huge opportunities. Satellite enabling connectivity for the 3 billion people who do not have broadband access. And even in the United States, there are 42 million without broadband access. We think because of the drop in satellite costs and the drop in rocket launching costs, and in fact, the convergence of many, I actually wrote them down here because as I was reviewing our slides, I said, wow, talk about convergence. And that is what we're seeing, the convergence of all of these technologies. So you've got the rocket and satellite costs coming down. You've got deep learning, mobile connectivity, sensors, 3D printing, robotics, and you've got a collapse in the decline of cost of rocket launches and satellite launches as well. One of the biggest breakthroughs has been SpaceX's reusable rocket. The Falcon 9 has been, the booster has been used 9 times. And Elon Musk started evolving this ecosystem because he plans to go to Mars. Maybe not himself at first, but he plans to send rockets to Mars. And it's absolutely essential that we have the reusable rockets. But you can see here the opportunity in the United States. The 42 million people who do not have internet access, their addressable market is $10 billion, and the $3 billion in the rest of the world, that's a $40 billion revenue opportunity. So very exciting. And hypersonic flight is the other big idea. We think this is a $270 billion opportunity. I see I have to speed up here because of the time. The reason we think this is going to happen is, time is money. And we already have a sense of what people will pay for private planes and first class. We made some very conservative assumptions here to come up with this $270 billion annual estimate for hypersonic flights, going from New York to Japan in 2 hours instead of 12 to 14 hours, whatever the case may be. Time is money, and people will gladly pay $100,000 for some very important meetings they need to attend in Japan. 3D printing, true valley of despair category. We've been pounding the table on this for a long time, and of course, the dagger in it this year last year was the coronavirus. That hit aerospace, autos, but particularly aerospace, the killer app for 3D printing, harder than almost any space. And yet today, I think I saw in one of the, it might have been the GE report, that planes are retiring at such a fast rate that the pace of airline deliveries is now outpacing the retirements. So that's good news. And it's good news for 3D printing. We do believe this market is going to scale at a 60% annualized rate during the next 5 years. We have been saying this for quite some time, and one thing after another has derailed it. The aerospace companies have gross margins in the 15 to 20% range. They're much lower this year, of course, but normalized. And so they have every incentive now to accelerate the use case for 3D printing on their planes. And we think that's going to be one of the largest opportunities. We always look for new ideas during the valley of despair, and so you'll see we increased our exposure to 3D printing in the last year.
I just saw a report, Cathie, on 3D printed houses.
Yes, China's been fast forwarding on that one. Yes, absolutely. They're tiny. But they're happening, and they're very expensive. They're prototypical right now, but that gives you a sense of where this is going. It's going to be ubiquitous as we bring the costs down and as the technology becomes more sophisticated. Now we're on to genomics and the genomic revolution. And I think the biggest aha moment for us in the past year is that long read sequencing is ready for prime time. Now, to give you a sense of long read sequencing versus short read sequencing, Illumina, which has been the poster child for the genomic revolution, in that 90 to 90% of all the base pairs of DNA being sequenced are on its machines. But they're short read, and Illumina has been unable to cross the chasm into long read. Long read, being able to read long sequences, enables much more reliability, much more a more comprehensive view of the genomic profile, and more accuracy than short read does. So Illumina is going to be a bit disrupted here by long read sequencing. Illumina tried to buy the largest long-read sequencing company out there, PacBio, and was rebuffed by the DOJ. Illumina knew that it was not going to be able to cross that chasm. And so it gave us an incentive to do more of a deep dive into long-read sequencing. And lo and behold, today, it costs about $1,500 to $2,000 to sequence a whole human genome using long-read sequencing, compared to roughly $500 we're getting down to with short-read sequencing. The cost of goods sold for long-read are about $1,500 as well, whereas for short-read, they're in the low 200s and falling. Now, short read is still going to have a place in liquid biopsies, which is a big frontier for the detection of cancer at very early stages. So that's good. But we do think the market is over time going to move to long read sequencing. So we're quite excited about the 82% compound annual rate of growth that we expect to see from long-read sequencing in the next 5 years. And here you can see again that cost of goods sold analysis. In the middle there, those two boxes. What this chart is showing is we are soon going to be at a point where multi-screening tests should be given to everyone in the 40 years and older range. And as the prices continue to come down along with DNA sequencing, that age range will be lower and lower. And of course, any in the high risk category should be able to get these tests. So we think we're going to find cancer at much earlier stages going forward. And that this is going to be, multi-cancer screening is going to be a $150 billion market in the US alone. And so, again, very excited about long-read sequencing and its impact on multi-cancer screening. And then finally, the new frontier for curing cancer, so gene therapies. I had to get used to the words allogenic and autologous. Which are gene therapies. Allogenic basically is off-the-shelf cells. Autologous are a patient's own cells. And we used to describe the power of immunotherapy being immunotherapies training our own immune systems to fight cancer, to kill cancer. Well, now there's an even cheaper way to do that. It's allogenic, off-the-shelf cells that have been trained to fight cancer, transplanting them into any patient with cancer. We believe this is going to explode the market over time for oncology gene therapy by 20-fold or $150 billion. So we're pretty excited about that. You can see that's the large periwinkle or lavender section here of this liquid and solid tumor therapy market. So you see that's going to be the biggest market. And we're seeing the very first signs of success there in early human trials. So just like with CRISPR-Cas9, which we featured last year, allogenic gene therapies are going to be the next big wave for cancer therapies.